U.S. stock market, if you look at it through the lens of the S&P 500 or maybe even say the NASDAQ 100, has essentially gone vertical so far in 2019. And I'm continuing to see more and more divergences in a bad way. So I put together 6 different charts that I think are very telling for a potential immediate term to medium term risk off period, where I think we could once again get a period where basically stocks drop, volatility goes higher. Now, obviously, this is not a guarantee in full disclosure, obviously, but it is something I feel quite strongly about. So let's go to the charts and let's have a look at what these charts are trying to tell us. All right, so let's have a look at these 6 charts. The first 3 charts are going to focus more on sort of the macroeconomics of things, if you will. And then the latter 3 charts are literally just from last week, from stocks, some very important stocks that are starting to break down. First of all, let's look at this chart that's in front of us right now. What we're looking at here is the S&P 500 versus the VIX. The S&P 500 is the line in orange, and then the VIX is essentially the candlestick chart here. And you can see these divergences between price and volatility. And while that's quite normal for when stocks go higher, volatility drops, it's when you get to these wides or the wides of the dispersion is when you really have to sit up and take notice. And we're definitely, by most measures, getting to a point once again where with stocks relative to the VIX are extremely overbought. In other words, VIX is extremely low, stock are extremely high. So I do think ultimately we could see another mean reversion move like we saw in early 2018, where the market dropped 15%, and then the 20% drop or so we saw in Q4. And so that's one risk. That's chart number 1. Chart number 2 takes the S&P and it compares it versus yield. Basically, versus the yield on 10-year U.S. Treasury notes. And here we have the S&P in green, and we have yields in red. So basically what this is telling us is that the fixed income market isn't really believing that the stock market is giving us all sorts of great growth, right? So basically, yields being this low doesn't exactly coincide or agree with the stock market ripping, because if the economy was doing so hot, then yields wouldn't be back at 2.5%, but maybe closer to 3.5% to 4%. So that's chart number 2. Chart number 3, and this is the last of the macro charts, and this is maybe one that may be quite new to a lot of people. One of the things that I do is in our weekly reviews, I track the price of lumber, among other commodities. And the price of lumber is actually extremely valuable on sort of a 2 to 3 month leading basis in terms of telling us what equities might do. So for example, last year, the price of lumber topped in May-June period, and of course the stock market dropped or topped in the month of September. Now what's interesting, and by the way I should say the S&P here is the line in purple, and then lumber is the chart or the line in green. And what you have is once again we're seeing this dispersion. So not only have stocks gone higher and lumber has gone lower, but lumber has completely given up its gains. So in about February or so, the price of lumber started to peak, and we're basically now almost revisiting the lows that the price of lumber saw in the month of October. So that's really, really interesting, and I think that does not spell good news for the stock market either. And thirdly, we're going to look at 3 stocks real quick, 3 really important stocks. We're going to look at Intel, we're going to look at UPS, and we're going to look at 3M. All right. So Intel, of course, a massively important stock in terms of semiconductors. It's the largest holding of the semiconductor complex, which is a really important part, also a leading indicator for the stock market. And you can see Intel, after a very, very steep rally, basically after earnings last week, gave us quite the drop, about 9% down the day. We're looking at this thing right here. So these sort of rising wedges that these chart patterns are reflecting are starting to break down in some important stocks, including Intel here, really getting clipped really big after the earnings report. Another one here is 3M. This is an industrial stock. This one here actually classically topped out at the upper end of its trading range. But really here too, we can see, and this is also from last week, is nothing, not cherry picking this, also a stock that had this sort of rising wedge pattern, if you will, and that started to break down in a really, really big way last week. Again, this is an important stock, a global company that really has insight into global demand for its goods and services. And lastly is UPS. Again, this doesn't need an introduction. Transportation stock, industrial stock, noteworthy. And this one too broke down in a classic fashion last week after earnings, after again, basically we were able to interpret what they're trying to say about the global economy. That doesn't look so amazing. So there you have it, three really important macro charts, three stocks that are basically reflecting the global economy, or at least the U.S. economy, and extended into the global economy. To me, none of this spells any massively good news. Now, what's the risk through all this analysis? Markets can certainly continue to squeeze higher to some extent, but I think even if they do hold up, the upside is rather limited. What's the sort of worst case scenario, or I guess what's the worst case scenario for bullish investors? What's the sort of best case for the analysis, meaning if stocks go lower? We could easily see a 10-15% in stocks very quickly, with the VIX spiking back above 30. That would be sort of the best case scenario for this particular analysis. And markets tend to surprise investors. So this would be something that would be coming as quite a surprise. If you look at, one of the charts that I was going to show you, and I didn't have time to bring it up, is basically consumer sentiment and investor sentiment, and particularly investor sentiment is once again getting rather bullish. So I hope this helps, folks. And if you have any questions or comments, leave them down below. Give us a thumbs up, like if you enjoy this, or subscribe to the YouTube channel.